A derivative is a deal between two parties to make a transaction in the future. Its value is derived from underlying variables ranging from oil and gold prices to agricultural products like wheat and corn, and even the value of cryptocurrencies like Bitcoin. Think of it like two friends promising to trade football cards next month, regardless of how much the cards' values change in the meantime. In the last 40 years, derivatives have become increasingly important, with some market analysts estimating their value to be more than 10 times that of the world's GDP. However, as seen in the 2007-2008 financial crisis, their large size and popularity can transfer a wide range of risks into the economy. A spot contract is like buying a product in a store. It can be bought and sold almost immediately. This differs from a derivative, which can be categorized into three different types of contracts: forwards, futures, and options. A forward contract is an agreement to buy or sell something at a fixed price in the future. For example, suppose that Dalio, a UK-based company, imports graphics cards from US-based Nvidia. The company would need to pay Nvidia $1 million in 3 months. To lock in the $1 million owed at a fixed exchange rate of £1 to $1.27, we would use a forward contract. This is used because without it, there are two possible outcomes. During the 3 months, the pound may weaken, costing more, or the pound could strengthen, saving money. A forward contract's role is to eliminate this uncertainty. This type of contract is traded in the over-the-counter market, a decentralized market for financial institutions and corporations, where trading takes place directly between two parties or with a central counterparty. This is the key difference between the next contract, futures, which are traded on a derivatives exchange, where individuals and companies trade standardized contracts defined by the exchange. These contracts include fixed terms like contract size, expiration date, and the underlying asset. A futures contract, like a forward contract, is a deal between two parties to buy or sell something at a specific price on a future date. Suppose that the futures price of gold is quoted at $2,400. This price is determined by the laws of supply and demand. If more traders want to go long than short, the price goes up, making a profit. If the reverse is true, the price goes down, leading to a loss. Market forces of supply and demand affect not only futures, but all derivatives. Understanding market dynamics leads us to options. Traded on both OTC and exchanges, there are two types of options: a call option to buy and a put option to sell. Imagine I buy a call option for Boeing stock, currently trading at $176. Each option contract represents 100 shares of the underlying asset. To own this option, all I'd need to pay today is the premium of $1 per share, totaling $100 for the contract. Once paid, owning this option means I expect the stock price to rise above the strike price of $182 by its expiration date. If the stock price reaches $190 by expiration, I would profit $700 per contract, after subtracting the premium cost. However, if I'm wrong and the stock price by expiration is below $182, the option would expire worthless. It wouldn't make sense to exercise the option to buy at $182 when I could buy the stock directly from the market at a cheaper price. A key difference between American and European options is that American options can be exercised at any time up to the expiration date, whereas European options can only be exercised on the expiration date itself. All three of these derivatives have been successful, primarily because there's a great deal of liquidity. This is due to the presence of three types of traders: hedgers, speculators, and arbitrageurs, who are active across all three derivatives. Hedging is like getting a flu shot before winter season. It provides immunity against the flu, even after being exposed to the virus. Much like the Boeing example earlier, where the option would expire worthless, resulting in the loss of only the premium, hedging provides protection against potential losses. If I had bought the stock in the spot market at $172 and it dropped to $179, I would have had a direct loss of $3 per share. Bearing in mind an options contract is 100 shares, my total loss would be $300. This is different from speculators, who leverage derivatives to speculate on future market movements. They can bet on the price of an asset going up or down. Arbitrage is typically the process of buying and selling the same asset in different markets to profit from price differences. If, for example, Bitcoin is trading at $64,200 on one exchange and $65,000 on another exchange, I could buy Bitcoin from the first exchange, and then sell it on a second exchange. After transaction fees, I'd have a risk-free profit of around $800. These opportunities don't last long, because as traders exploit these price differences by buying low and selling high, their actions drive prices back toward equilibrium. Hedge funds are users of derivatives for all three purposes. Similar to mutual funds, which invest funds on behalf of clients, hedge funds do not publicly offer their securities, accepting funds only from professional fund managers or financially sophisticated individuals, and are not subject to certain mutual fund regulations. This regulatory freedom allows them to create advanced, unconventional investment strategies. Let's say I invest $1 million in a hedge fund. The fund charges a 2% management fee, so $20,000 is deducted annually just for managing the investment. If the hedge fund performs well and my investment grows by $100,000, a 20% performance fee is also charged on that profit. This means I'll pay an additional $20,000 in fees based on the fund's performance. Hedge funds have gained popularity, with about $2 trillion invested globally. However, the versatility of derivatives can lead to problems, as traders meant to hedge risks may become speculators. This occurred during the 2008 financial crisis, when speculative behavior, high leverage, and poor risk management, despite warnings from risk managers, prompted government intervention.